Hi, everybody. So what I want to, again, talk about today is what's going on south of the border there in the U.S. economy. And we had a pretty significant event that took place not too long ago. And it's been something that I have been forecasting for a while. The Federal Reserve basically did a complete about-face when it comes to interest rates. When the fourth quarter of 2018 began, and pretty much for most of the quarter, the expectation was that the Federal Reserve would raise rates 3, maybe 4 times in 2019. And in fact, those expectations were pretty well grounded until kind of mid-December. But ever since early January, now very few people expect any rate hikes at all in 2019. In fact, more people think it's more likely now that the Fed will reduce interest rates in March than raise them. And that is completely the opposite of what people thought, as early as even a few weeks before the end of the year. Now, when the Fed raised interest rates in December, a couple of days before that, I was even on television in the States on Fox Business, and I said at that time that if the Federal Reserve raised interest rates in December, I thought that that would be the last rate hike of the cycle. And now a lot more people have come to that same conclusion. But I have been forecasting that the Federal Reserve would not be able to complete its rate normalization process since before they raised rates for the first time. If you go back to the years before the first rate hike, which did not occur until December of 2015, before that hike, I was basically predicting that I didn't think the Fed was going to hike at all. I thought it was all a bluff. I said they're not going to raise interest rates because I thought that they were smart enough to realize that would prick their own bubble, that they had inflated this bubble over time. They had kept interest rates at zero for and then 6 years, whatever, and that as a result of that, they had inflated an enormous bubble, and they would not be dumb enough to actually prick it by raising rates. But of course, they couldn't admit that. They couldn't say they couldn't raise rates, so they would have to pretend that they were going to raise rates, but then keep coming up with excuses for not raising them. And that's what I was saying. And for a long time, I was right. Because if you go back to the beginning of 2015 or the end of 2014, just about everybody thought that there would be 3 or 4 rate hikes in 2015. And we only got 1. And we didn't get it until the December meeting, 2 weeks before the end of the year. The Fed waited the entire year before raising interest rates from 0. And they notched them up 1/4 point. When they did that, I said, okay, they've raised rates just to prove they could. Maybe they were under a lot of pressure because they'd been bluffing all year, and maybe the markets were getting wise. Hey, why is the Fed not doing anything? So at the time I said, you know what, it's probably one and done. I thought maybe they're just doing this just to kind of prove that they can, and now they don't have to do it anymore. And again, people thought, well, no, they're going to keep on raising. And after the first rate hike, most people expected, 2 or 3 more during the year. But after they hiked up rates 1/4 point, stock market tanked, and the Fed backed off. They didn't do another 1/4 point rate hike until December of that year. They waited an entire year to go up another 1/4 point. And what happened between the first 1/4 point rate hike and the second one was an election. Donald Trump won the election. I still believe that had Hillary Clinton won that election, which was widely expected, I think it would have been one and done. I don't think the second rate hike would have taken place had Hillary Clinton won. Right? And the reason I think that is I think that the Federal Reserve at the time, and certainly Janet Yellen, were more sympathetic to an orderly transition to the Clinton administration, and they did not want to complicate her presidency with another rate hike, given how violently the markets reacted to the first one. And I also think that if you look at where the U.S. economy was going into that election rather, I think we were getting very close to the next recession. I think we were getting very close to a bear market. Remember, the U.S. stock market really stopped going up the minute the Fed started tapering or stopped its QE program. Stock market was going sideways for a long time. And it looked like it was going to roll over. And I think that had Hillary Clinton won, the stock market would have tanked. The conventional wisdom before the election was that if Trump won, it was going to be a disaster for the stock market, but that if Hillary Clinton won, the market was going to like it. Well, Trump won, and the market went way up, the opposite of what was expected. I believe that had Hillary Clinton won, the market would have gone down, also the opposite of what had been expected. And I believe the U.S. would have entered recession much sooner. You know, this is already the longest, or was the longest bull market in U.S. history. I think it's the second longest expansion in U.S. history, measuring GDP. I think it would have come to an end early in the Hillary Clinton administration. And so the Fed only would have had one rate hike, and they would have been back at zero. And the reason that I originally said that I did not expect the Fed to raise rates again was because I knew that raising rates was the first step in a journey that they could not finish. That in their attempt to normalize rates, the stock market bubble would burst and the economy would, re-enter recession. And those are two things that the Federal Reserve did not want to happen, right? Because they inflated this entire bubble economy based on the wealth effect of, overpriced stocks and real estate. And during the time period where the Federal Reserve kept interest rates artificially low, they encouraged everybody to take on more debt. So instead of reducing the amount of debt that we had, which would have been the correct thing, that would have been what the market would have delivered, the Fed was able to spare the economy of the market-related cure, but only by allowing the disease to progress to a much larger scale, meaning we took on a lot more debt. And so normalizing interest rates when you've created an abnormal amount of debt is impossible. And I think I would have been right. Had Donald Trump not won, it would have been one symbolic quarter-point rate hike, and then we would have been back to zero and we would have relaunched QE. And I knew that if the Fed tried to raise rates, tried to normalize rates rather, but then failed from a credibility perspective, from a PR perspective, I thought that would be a disaster for the Fed because it would prove to the markets that they couldn't do everything they were saying they were going to do. But if they never even tried, then at least they can pretend they could do it if they wanted to, right? But by trying and failing, they would prove to the markets that they couldn't do it. But anyway, so now Donald Trump gets elected and the stock market goes up. Surprises everybody. And everybody gets excited. Everybody gets optimistic. Trump's going to make America great again. He's going to cut taxes. He's going to cut regulation. And it's going to be a boom. And all of a sudden, people got optimistic. After 8 years of, a phony recovery, which is the reason that Donald Trump got elected, because he told the truth about the phony nature of the recovery. He told the truth about government statistics and how they deliberately misrepresent the strength of the economy. And the voters, that message resonated because it was true. And so Trump got a lot of votes that he may otherwise not have received. But all of a sudden, a lot of people are optimistic. Certainly small business is optimistic. He's going to get rid of all this regulation. Well, that's great. I got all kinds of regulations. So the idea that maybe we're going to have deregulation is going to be good. Oh, Trump's going to cut taxes. Well, that's great, right? Everybody wants lower taxes, at least the people who are paying the taxes. So you had this big surge in the stock market. Again, finally, another big, I think it was the blow off top, like the end of the mania. But it was fueled not only by optimism, but by the actual cash generated by corporate tax cuts. We did cut corporate taxes, so corporations had some extra cash that they were no longer sending to Washington, D.C. And so what did they do with that cash? They just bought back their own stock. Even though it was already overpriced, they just bought more shares, right? And so the stock buybacks that were, created by corporate tax cuts and the optimism that fueled some excess consumption, excess spending, helped create a sense that the economy was stronger than it was. And that provided the cover for the Federal Reserve to be able to continue notching up interest rates. So even though they only raised interest rates once before, while Obama was president, technically they did it twice, but that was after he was already, out and Trump had, won. They kept raising rates under Trump every single quarter that they met. They kept raising rates. And it kind of created a bit of a false sense of security that, hey, we can keep on doing this. But I knew all along that at some point, that would be it, right? The straw that breaks the camel's back. I didn't know how many rate hikes the bubble economy could take, but I knew there was a limit. And I still knew that there's no way they were ever going to get back up to normal or neutral. Whatever that number is, it ain't 2%. Right? But I knew that since we had so much debt, right, an abnormal amount of debt, that it wouldn't take much to prick the bubble. And of course, as we got some of the enthusiasm was starting to wear off for the booming economy, as the rate hikes were beginning to take their toll, you could see it in the real economy. You can see the housing market in the U.S. imploding. You can look at actually the weakness in the home building stocks. Weakest since the financial crisis, in fact, even weaker. Look at the banks. Bank stocks are imploding. They were one of the first sectors to go into a bear market. I remember, analysts were trying to say, oh, buy the banks. The banks are going to benefit from rising interest rates. From the beginning, I said it's the opposite. The banks benefited from lower interest rates. Higher interest rates are going to kill the banks. Low interest rates made it cheaper for people to borrow money. Well, that's what banks do. They sell loans. They can sell more loans when they're cheaper than when they're more expensive. But the other problem that I said the banks are going to have when interest rates go up is because collateral is going to lose value. Loans are going to be defaulted on. Banks are going to lose. So this started to happen. Retailers, automobiles. You're starting to see, huge, collapsing in Ford price, General Motors, auto sales coming down, because all this was built on credit, right? Everything that the Federal Reserve built up based on cheap money was starting to implode as the cheap money was being withdrawn. Now, of course, 2% is still pretty cheap, but when you're, used to zero, when you build an economy on zero, just like a drug habit, right? If you're used to a certain amount of drugs and then you get less of that drug, your body can't survive. You have a certain level that you now need. And so the U.S. economy is built for zero. It's not working at 2%. And you're starting to see that. But the markets are still kind of oblivious to what's going on. But then when Powell raised rates in December, the last rate hike, or not December, in September. I remember that rate hike. And the rhetoric was much more hawkish, and of course it's all relative, but then the markets expected, right? He was like, everything is great, there's no problems as far as the eye can see, and I'm just going to keep on hiking rates, and we're going to move forward with our plan to shrink our balance sheet, reverse all the quantitative easing with quantitative tightening. And I remember particularly thinking, that's a very dangerous speech. And I remember I titled my podcast the next day, The Rate Hike That Breaks the Camel's Back. And I began to think that, that's it. I mean, I think the Fed has just, pushed it too far as pretending that they can keep on doing this. And then finally, the stock market, followed some of the economic data, and we had the worst fourth quarter in almost the history of the U.S. stock market. In fact, the month of December was the second worst December since 1931. And of course, we were in the Depression in 1931, and it would have been worse than 1931 had we not got a bit of a truncated Santa Claus rally. We had the worst Christmas Eve sell-off in the history of the U.S. stock market by a wide margin. And I think a lot of people were panicking, and all of a sudden they sent the Federal Reserve officials out to start doing exactly what I said they were going to do from before they raised rates for the first time. Because I said, right, if they start to normalize rates, they're going to create a bear market, they're going to create a recession, and then what are they going to have to do? They're going to have to do something. And what I was always saying was, obviously, before they cut rates, they got to stop raising them. So that's what they did. They basically came back to the markets and threw them the lifeline that they had been hoping for. They went from being hawkish, we don't care about the markets. As soon as we hit that 20% down bear market, right? In fact, the Russell 2000 was down more, I think 27%, I forget how much, but the transports went into a bear market. The NASDAQ was in a bear market. I think the S&P just barely hit it at down 20%. The Dow officially didn't quite make it. I think it was 19. But I mean, they weren't going to stand around and wait. They knew that they had to, reflate this bubble because this whole phony recovery was built on the wealth effect associated with rising asset prices. So they came in and did exactly what I said they would do, which was, okay, we're pausing, we're on hold. And in fact, a lot of the Fed officials are going out of their way to say, look, we're not worried about the economy. We don't see evidence of a recession, but we're going to be on hold anyway. Well, why is that? In fact, when they asked Powell if he thinks there's a recession coming, he was like, well, no, there's no chance of a recession. We don't see a recession. Of course, they've never seen a recession, including the recession of 2008. Even when we were in it, they couldn't see it. They thought everything was fine. But Powell, when I was listening to this interview, he said, well, there's two things that cause recession. He said one is when there's too much inflation, right? And then the central bank has to come in and really, get aggressive and raise interest rates. And he said, I don't see any signs that inflation is a problem. And of course, we've just created a massive amount of inflation. Quantitative easing is just a euphemism for inflation. That's what inflation is. Expanding the money supply, putting up money and buying government bonds is the definition of inflation. The Fed has been inflating like crazy. So to say that we see no dangers of inflation, why did he think the stock market went up? Why did the real estate market go up? Why did the bond market go up? Those are all prices. What made those prices rise? The inflation created by the central bank. I mean, they did that on purpose. So clearly inflation is a threat. And what's going to happen with inflation is the effects are going to move from the financial assets to the real economy, to food, to energy, to stuff like that. But the Fed doesn't see that. But what was even crazier to me is the next thing that Powell said. He said the other reason that you might have a recession is when you have asset bubbles and excess leverage. And then he said, there's no sign of that. Now, how can you look at the U.S. economy that has more leverage now than ever before and say there's no sign of excess leverage? How can you look at the biggest financial bubbles that have ever been inflated and say that there's no bubbles? The bubble we have now is bigger than the one that popped in 2008. We have more debt now than we had back then. And of course, it's not just individuals who have more debt. Now, they don't necessarily have more mortgage debt because a lot of people that used to have mortgages no longer own houses, so they just pay rent, but they have more credit card debt, they have more student loans, they have more automobile debt, and they have lower net worths because to the extent that they used to have home equity, obviously renters don't have any equity. So individuals are loaded up with debt. Corporations have got a mountain of debt. But look at the U.S. government. Look at how much debt the U.S. government has now. I think the national debt, it may have ticked past $22 trillion in the last, I'm not sure, I haven't, but last time I looked at it a week ago, I think it was 22.94 or something like that, or 21 rather, but 22 trillion. When we had the financial crisis, maybe the national debt was like 8 trillion. And now, of course, because of, the Trump tax cuts, we didn't make government less expensive when we cut taxes. We actually made government more expensive. Part of the problem is we didn't deliver any real relief to the economy when we cut taxes. We just decided to fund the government through debt instead of taxation. But we also increased spending on the military and social welfare spending. And so we're now running deficits during this recovery that are larger than they were during the Great Recession. The U.S. government is borrowing in excess of $100 billion every month to fund the gap between what they collect in taxes and what they spend. And of course, they report the annual budget deficit. They only report a fraction of what they're actually borrowing because the government only includes what they put on budget. Everything they have off budget, they don't include the money that they've borrowed. Even though they have to borrow it just the same, they have to issue treasuries to finance the off budget spending. When they report the official budget deficit, they exclude all that. But if you just look at how much the national debt is going up, then you know what the budget deficits are, because every year the national debt increases by what the budget deficit is. But it increases by a much bigger number than what they claim it is because they leave all this stuff out. But we're adding on debt at a much faster pace than we were then. So we have all this extra debt, yet the chairman of the Federal Reserve says, oh, we're not worried about debt. And like, we're going to keep on raising interest rates. How are they going to keep on raising interest rates when everybody has so much debt? And every time they raise interest rates, they make that debt more expensive. In fact, another thing they do when they raise interest rates is they drive themselves further into bankruptcy. Right now, if you look at the balance sheet of the Federal Reserve has a huge negative net worth. Because what is the Federal Reserve's, or what are their liabilities? Their liabilities are all the Federal Reserve notes. Even though they're not obligated to give you anything for a Federal Reserve note, the Federal Reserve notes are their liabilities, the money in circulation, the money they create. What are their assets? Their assets are the things that they buy when they create those notes and spend them into circulation. And so it pretty much consists of U.S. Treasury bonds and mortgages. Well, as interest rates have been rising, the value of those securities has been falling. And so now the mark-to-market value of their assets is well below the value of their liabilities, so they are technically insolvent. And the more they raise interest rates, the greater that insolvency problem comes. So, everybody is all leveraged up, and the Federal Reserve is trying to pretend that they don't see a problem. If they didn't see a problem, why did they stop raising rates? And the reason they stopped raising rates is because the problem was staring them in the face, and they couldn't allow the recession, or they couldn't allow the bear market to get worse, because if they did that, then the reverse wealth effect would come into play. If they deliberately created this recovery by creating assets prices, or through the wealth effect, through quantitative easing, it doesn't take a rocket scientist to figure out that if you reverse the process and asset prices fall, well, then you're going to have a reverse wealth effect. And if getting richer makes you spend more, well, getting poorer will make you spend less. So the Fed basically had to call off the rate hikes. Now, what is the next step? Well, I also have been making this forecast. What I have been saying since the beginning was that when the Federal Reserve finally has to stop raising rates because it's hurting the stock market and the economy, that at best, that decision would provide a temporary boost to the markets. And that's what we've had, right? Since the Fed did that, we've had a big surge in the stock market. Now, of course, most of the financial media think that, oh, the bear market is over now because the market is going up. I mean, they keep saying, oh, we're out of correction territory now because we're no longer down 10% from the top. No. This is the correction territory. See, people forget that in a bull market, the corrections are when the market is going down. That's the correction. But when you're in a bear market, the correction is when the market is going up. Because the trend in the bear market is down, but you correct that move every once in a while. You'd have a little bit of a move up before you resume the trend. And that is where we are now. The Federal Reserve created a correction in a bear market by coming to the rescue of the stock market, by calling off the rate hikes. That's what was scaring the market. Oh, the Fed's going to keep on hiking rates. That's going to push the economy into recession. Now the Fed says we're not hiking rates anymore. Oh, okay, we dodged that bullet. But the problem is, it's not the future rate hikes that we're going to push the economy into recession. It's the past rate hikes. They've already guaranteed it. Now, that doesn't mean what I'm saying is the Fed was wrong to raise interest rates. They weren't. They should have raised them more, and they should have raised them a lot earlier. The mistake was not raising rates. The mistake was cutting rates. The mistake was taking rates down to zero. The mistake was leaving rates at zero for as long as they did. The mistake was raising them too slowly. This is exactly the mistake that the Federal Reserve made under Alan Greenspan. Why did we have a financial crisis? Right? I mean, it should be pretty obvious by now. Right? Why did we have one? We had one because when the stock market bubble popped, instead of allowing the market to function, Alan Greenspan slashed interest rates to, at the time, 1%, which looked like, a ridiculously low rates until we eventually, went to zero and we went beyond the ridiculous and the sublime. But you go back to the decision to move rates to 1%. Greenspan lowered rates to 1% to try to stop the stock market from falling, to try to truncate the recession, to prevent the recession from, just running its course. All that was a mistake. The Fed is not there to put a put beneath the stock market. The Fed should not be trying to shorten a recession. There's a recession for a reason. There's a reason because you have misallocations in the economy. You have malinvestments that have been made based on a previous boom. And the recession is the cleansing process where the market can restore balance to the economy, create a sound foundation to build a real recovery on. But that process got cut short by the Fed. And then they left interest rates at 1% for a year and a half, whatever it was. And then they raised them very slowly, quarter point every time they met, until they eventually got back up to 5.25, wherever they got 5.5. But because of that, because they kept interest rates lower than the market would have otherwise set them, they encouraged all sorts of borrowing that otherwise never would have taken place, particularly concentrated in the housing sector. And you had this housing bubble that popped, in 2007 and caused a crisis in 2008. And then what did the Federal Reserve do? Instead of learning their lesson, they did exactly what they did before, only now because they had a bigger bubble, they had to do it on a grander scale. Because they lowered interest rates to 1% last time, and they created a bigger housing bubble than the dot-com bubble. Well, now 1% wasn't low enough. Now they had to go to 0. And they had to leave them there for an extended period of time, and even that wasn't enough. The bubble that they had inflated was so big that they needed to do 3 rounds of quantitative easing to try to create this phony recovery. But what I've been saying from the beginning is the bubbles that they have created since then, well, we can't go negative. Europe did it, but we're not going to be able to take rates to nominal. We're going to have to do the next round of quantitative easing. We have so much debt that, what we're going to have to do for QE4 is going to be larger than QE1, 2, and 3 combined, and maybe, doubled it again. And so what I said is that, okay, so the Fed is going to stop raising rates. We're going to get a short-term rally, but that's it. This is a bear market correction. The market's going to roll over. The bear market isn't finished, and the recession is still coming. Not because it's not the future rate hikes that guaranteed the recession. It was the previous rate hikes, but again, not even the rate hikes, it was the rate cuts, right? Once you build an economy on QE and 0% interest rate, it dies by it as well. Either you're going to remove the stimulus or you're going to die of an overdose, one or the other. But the recession is inevitable. It is the inevitable consequence of the mistake that the Federal Reserve created when it inflated the bubble. It's actually the healthy part of the process. Where the mistakes are made is during the bubble. Where the market fixes them is during the bust. So the recession is coming anyway. It doesn't matter that the Fed stopped hiking, and the bull market is over, and the bear market is going to continue. And at some point along the way, around 2019, I think the Fed is going to have to rescue the markets again. But this time, they're going to have to cut rates, right? All they did before, they said, okay, we're not going to hike them. But when that's not enough, when the market is going down and the economy is going into recession, they're going to have to cut rates back to 0. They're going to launch QE4. But there's 2 huge problems with this. One is that it's not going to work this time. Not that it didn't work that it worked last time. It just worked in that it created a bigger bubble. This time, it's not going to create a bigger bubble. It's just going to blow up. Because people are then going to come to the conclusion that I said from the beginning, which is why I said I didn't think the Fed would raise rates at all, because the minute they have to abort the process prematurely, the minute we're back at 0 and back at quantitative easing, the world's going to wake up and see through the charade that this is not a temporary solution, that it's 0% interest rates forever, that the balance sheet is never going to return to its pre-crisis levels, that it's going to grow in perpetuity. And if the Fed couldn't shrink a $4.5 trillion balance sheet, if they have to blow it up to $10 trillion as a result of the next recession, how are they ever going to shrink that? If they couldn't normalize interest rates when the national debt was 22%, 22 trillion, how are they going to do it when it's 30 trillion or 40 trillion or 50 trillion? People are going to realize that, we checked into the monetary Roach Motel that I talked about from the beginning, and that there's no way out, and then the dollar is going to fall like a stone. The reason the dollar rallied during QE3 is because people thought it was over, and people thought that it worked. When they find out that it's never over and it didn't work, then there's going to be nothing propping up the dollar, and it's going to drop like a stone. The price of gold is going to take off, and the recession that we're entering into, which is going to be an inflationary recession, is going to be worse than what we now call the Great Recession that we had in 2008 and 2009. And as a result of that, if we enter the recession sometime in 2019, we will still be in it in November of 2020 when America elects a new president and a new Congress, and they're not going to be Republican. Trump, as I said, is going to be the Republican version of Jimmy Carter. I believe I said that when I was here a year ago. He's not the next Ronald Reagan, but the next Jimmy Carter. Of course, Jimmy Carter was a Democrat, but what Jimmy Carter did is pave the way for Ronald Reagan. He made it possible for us to go hard right because the economy got so bad under Carter. Well, Trump is going to accomplish the same thing in reverse because he inherited a bad situation, but instead of leveling with the American public about how bad it was, he immediately claimed that everything was great. He put his moniker, his big T, Trump, on the stock market bubble, on the economy, and claimed we have the greatest economy in the history of the country, and we have this great market, and when it all implodes around him, he's going to get blamed. But more importantly, it's not just Trump, but what Trump supposedly stands for was his less government, deregulation, lower taxes, and the solution that Americans are going to gravitate towards is going to be socialism. Socialism is now mainstream. The Democrats in America, there were usually a lot of socialists within the Democratic Party, but they were in the closet. They were afraid to come out. Now it's fashionable. Now, people think it's hip and new. They have no idea, just how many times socialism has failed. They're all ready to try an experiment that we know how it's going to end. But I think that's where the political winds are going to be blowing. I think that the Democrats are going to nominate somebody who is identified as being a democratic socialist. And since the economy is going to be in such bad shape, in 2020, when they go to the polls, they're going to vote socialist. And so this recession is going to turn into an inflationary depression. And a lot of the people who got so optimistic on the U.S. stock market and piled in after Trump was elected because they thought, he's going to make America great again by cutting taxes and lowering regulation, the reverse is actually going to happen because the Democratic Socialists are going to take us in a completely different direction of excess taxation and excess regulation to try to fund their laundry list of socialist programs that they want to enact. But of course, normally you need to be a wealthy country in order to squander your wealth on socialism. The problem is America is already broke. And we're going to try to implement socialism from a position of weakness rather than a position of strength. And I think, again, I'm out of time, but this is going to be the trigger that causes the run on the dollar, causes the dollar to lose its reserve currency status, and forces a difficult choice for the Federal Reserve and whoever is the chairman at that time, because we're going to have two difficult choices, neither of which is going to be pleasant. One is to save the dollar from complete oblivion and hyperinflation by allowing interest rates to rise dramatically and just letting the chips fall where they may, which will involve a far worse financial crisis than '08 and with no bailouts. And it won't just be banks failing. It will be depositors losing their savings because there's no way to bail them out. If the Fed is tightening, they can't bail out the banks. The government's going to have to default on the national debt and also default on a lot of the promises that have been made to American citizens in things like Social Security and Medicare and stuff like that. So they could do that, or the alternative is actually worse. The alternative is, they just ignore that. They don't care how much value the dollar loses. They don't have the integrity to default on anything, and they want to pretend that they can pay all the bills, and they do it by just creating money. And then you have the hyperinflation, and the dollar ultimately returns to its intrinsic value, and we know where that is. Anyway, but before that happens, there still is a window of opportunity, I think, to make the right investments. Probably a lot of people in this room have probably been, they probably have already prepared themselves for it. But there are a lot of people that have not, and I think the ability to do that, that window is going to be closing as we get closer to the point where the Fed has to cut rates back to zero and do QE. I think if you wait till they actually do it, then you've waited too long. But you need to anticipate what is going to happen, because I think what they've already done should be enough to show you where they're going. The fact that they had to abort the process at 2.25, the fact that they were forced to do such in a back phase, that should tell you, right? If you thought that they could do it, that should be the first warning bell that says, you know what, Schiff was right all along. Maybe it's taken longer than we might have thought to play out, but this is the beginning of the end, and we don't have that much more time. Anyway, I know I'm out of time, so thanks everybody.